All right. Welcome everybody. We are in the second stakeout. Awesome topic today, the LSTfi explosion. And we've got some awesome guests to welcome today. So welcome Anton from Pendle. We're still waiting on our friend from Ethena Labs, Altair from unshETH, and Amplice from Gearbox. And of course your host today, Spadaboom. For those new or tuning in for the first time, we do this as like a roundtable discussion. So after we've concluded all of our great chat, and time permitting, we'll open the floor. So anybody who's interested in coming up, asking a question, or joining the convo, try to hold it till the end, and you can raise your hand throughout. We'll pull you up later. And with that, I'll hand it over to you, Spot. Kick us off.
Sure, great intro, Will. I gotta say that was fantastic.
Appreciate it. Thanks.
So, guys, I think unshETH Cruz suggested this is a bit of a reunion. It's funny because if you just keep building and sticking around the space time and time again, you keep bumping into the same people. I even remember, you know, um, back in the early Kyber days, around 17 when it was first kind of popping and connecting with TN, and then all these years later, kind of the Pendle crew rocking and rolling. It's just cool all around. But nonetheless, I'm excited for today. I think it's going to be awesome. I'm obviously pretty bullish on the whole LST-Fi and the explosion of ETH staking, how that's going to affect DeFi moving forward. So um, I'm going to just kind of talk through a few different topics over time and call on some folks. But of course, always feel free to, if you have something to say, jump in and share it, open forum. But, I'll start with a pretty high level question here, which is like, obviously ETH staking has been exploding in the last year. And as you look at, the impact that it has on DeFi already, and even some of the TVL, I think it's, upwards of 600 or 700 million or almost $1 billion worth of TVL. If you were to include what's being used and leveraged across places like Maker and Aave and Curve, you're well over the 3 or 4 billion mark in terms of how staked ETH is being used. But the real question is like, what type of role will LSTs actually have, or will they play in DeFi moving forward? Is this something where, some people suggest that it's going to replace WETH. Other people suggest that all liquidity pools are going to be against some type of staked ETH versus normal ETH. The amount of protocols and the type of economic designs that can come from these protocols being built on top of LSTs or the ETH staking layer in general are pretty much endless at this point. So I'll kind of start the conversation and point that question, Anton, at you. Share your thoughts. What do you think about the role of LSTs moving forward?
Sure. And yeah, thanks as well. Happy to be here. Thanks, Spot and Will, for the invite. Love the name for the space as well. Stakeout. Very cool. Yeah, so some thoughts there about LSDs and DeFi. Just last April of this year, right? So liquid staking or the liquid staking sector has become the largest sector in all of DeFi and all of crypto. Last I checked in DeFi Llama, which has a combined TVL of about 21 billion right now. And that makes it like, makes lending and DEX basically second and third. And they used to be the top sectors in all of DeFi. So it already has a significant role in all of DeFi in general. Now for LSDFi, which basically represents the use of LSDs in financial applications and blockchain, still roughly has a cumulative TVL of about 700 billion, which only represents 2% of that entire 21 billion liquid staking sector. So that represents a 98% addressable market for the rest of LSDFi. So using LSDs in DeFi represents an enormous upside for the rest of DeFi. And I think we've started to see this explosion with the various forms of LSDs. So on Ethereum alone, we've started to see, STETH, RETH, SWIFT, ETHX, OETH, FaxETH, UniETH, TETH, and so on and so forth. The explosion is basically quite crazy on the amount of these different LSDs that are coming out just within this year. So, and LSD yields, right, are basically spot deals with different rates, fluctuating based on different variables such as, validator win rates, MEV fees, and slashing. So it's possible to build something analogous to US treasuries, but using staking yields. which is basically something that we're trying to build within Pendle as well. So with the different LSD maturity dates on Pendle, then we can build that yield curve of which the end user can choose his risk exposure to those different ETH staking yields. And I think we'll start to see more complex and sophisticated DeFi products that make use of this staking yield in general. So yeah, I think there's a lot to look forward to in the space in general.
Well, Anton, let me ask you as a bit of a follow-up because you mentioned so many different LSTs. Like, are we going to see in a year or two from now or 3 years from now, literally just hundreds, if not thousands, of different liquid stake derivatives or tokens?
Yeah, good question. I think that there's definitely a low hanging fruit right now where, well, during the early years, right, like 2020 or so, we only had basically Lido and I think Anchor as the leading liquid staking solutions out there. And they were mostly capturing all these fees, right? And I think that, with the Chappelle upgrade, it basically gives more confidence into that withdrawal mechanism. I think that it just made sense for a lot of these different builders to take part of that, to be able to capture that fees, et cetera. And I think that there might be still, that margin of growth where, these different builders can capture that. But I think that for any explosion, similar with what we've seen with the ICO boom or DeFi summer or NFT summer, things will probably slow down and start to consolidate. So with this huge explosion, maybe some of them will start to die down or maybe even converge with other existing solutions, et cetera. So yeah, I think with every cycle, right, we'll always see some explosion and then some leveling off and then start to consolidate over time.
Fair enough. I think there's quite a bit of an explosion to come. I don't even think we're anywhere close to kind of DeFi summer vibes yet, which is pretty exciting. But I'm gonna pass the baton over to unshETH for a second because it's a good perspective when you talk about what Pendle does in particular, and then you kind of take both of those questions and you look at taking more of a basket approach to what unshETH does. What's your perspective on the role, not necessarily just on how protocols are designed on top of liquid stake tokens, but even in general, how much of a proliferation liquid stake tokens are going to have across DeFi?
Yeah, great question. So I had this thesis maybe back in December that the only thing really holding back LSDs from being used everywhere and from replacing WETH was the Shanghai upgrade. Specifically, um, once LSDs were sort of able to be redeemed, um, I kind of thought there's no good reason for them to not just replace ETH or WETH everywhere, right? And that was sort of the thesis on top of which unshETH was founded. Um, we wanted to essentially build LSDFi as DeFi protocols, but with LSDs as a first class asset, right? Whether that be lending protocols that use LSDs as collateral, whether it's DEXs that have LSD denominated pairs or anything more exotic than that. Um, so, I mean, the short answer is LSDs, whether it be unshETH, whether it be someone else's LSD product, should and will replace WETH everywhere. The only use case for unstaked ETH, as far as we are concerned, is just paying gas fees, right? Um, so really, like, we want to see all ETH become staked ETH. I think we're getting closer and closer every month. At the beginning of the year, something like 13% or 14% of all ETH was staked. I believe that number now sits over 20%. Um, and as far as just having this basket approach of unshETH and why that's important, um, I think as we're trying to replace ETH with staked ETH, it's important to not accidentally create a giant mm, regulatory or other sort of attack vector for Ethereum, i.e., you don't want the one staked ETH product that everyone uses to be under the control of a couple of people who are all subject to the same maybe operational or regulatory risks, right? Um, it would be very bad if all of the stake ETH was controlled by yeah, a couple of people who all live in the same country, for example, or who are all owned by the same VCs who all live in the same country. I'm not going to name names, um, but existing solutions do pose those risks, and we feel that diversification on the LSD level, on the client diversity level as well, will sort of help to mitigate this risk so that we can have stake ETH be this like positive something for everyone without accidentally shooting ourselves in the foot and blowing up the security of the network.
Well, we're starting to get spicy already. We're gonna go to the decentralization path. Let's hold that. Let's hold that for a topic in a bit because that's obviously a pretty critical one. I think speaking to that in particular, you talk about, and a lot of people have talked about liquid stake ETH replacing WETH. I think the biggest thing holding that back is the centralization of certain liquid stake tokens today. Right? There's a lot of upgradability at a token level, separate from nodes and the validator set and everything that's happening behind the scenes, but even just at a pure token level, a lot of these liquid stake tokens have pretty clear centralization risks. So I think that's going to be and continue to be the main factor that holds that back. And we could talk about that in a bit, but I want to kind of point that same question to Lepto. Welcome from Ethena. And I know you have an interesting perspective, being more on the stablecoin side, but I'd love to get a feel for, what do you think about the proliferation of LSDs and LSTs and DeFi moving forward?
Yeah, thanks for having me on. I think it's kind of already happened this year, right? If we look at the project with the most TVL, just sort of going through the list, you have Lido at the top, Maker and Aave afterwards, and most of sort of the assets that are actually sitting on those money markets now are LSTs as well. So I think it's kind of already happened, and really the only thing that's sort of going on within DeFi right now is innovation around what are we doing with liquid staking tokens and sort of the yield that's associated with it. So it does feel like the only area where you're seeing some innovation in the market at the moment, and I think it's only set to continue.
And how do you see that playing a role in stablecoins? Like we've seen a ton of stablecoins come out recently that are exclusively backed by liquid stake tokens. But how do you see that on the stablecoin side and how that affects that and those designs?
Yeah, I think part of the interest has got reason it's got so much interest is part of what's happening with rates in the real world. So the fact that sort of DeFi returns fell below risk-free rates in the real world meant that we needed a new source of yield within crypto to actually sit behind stablecoins. Steth was obviously, or other liquid staking tokens was obviously like a natural home for that, where you actually have an asset with a large enough yield to actually support stablecoins as a product. So I think that's going to continue. There's obviously a lot of innovation going around, whether it's sort of new versions of CDPs with borrowing dollars against liquid stake collateral, or some of the innovations you're starting to see around the delta neutral designs. I think that's just going to continue as well.
Yeah, I agree. Obviously I'm extremely biased because, we've just spent the last year designing the BTC protocol, which akin to what you suggested, right? Having an LST behind, a synthetic asset that intends to be pegged to whatever, if that's the US dollar, if that's the Bitcoin price, if that's the gold price, whatever it may be, having that base yield changes the entire economic design surface. And that innovation space that we're now going to see where there's actually sustainable yield, not just a bunch of kind of random tokens that have gone up a bunch and, oh yeah, look at all this yield because this token went up from was created yesterday to however many millions in market cap, and folks taking advantage of that type of stuff. But genuinely scalable under the hood yield and exclusively on chain, to your point, like we see some of the stuff that's happening in the DAI ecosystem, for example, and how they use real world assets and access to more traditional returns to drive that back into DeFi. I think that's great. And I think there's, a whole space exploding there. But to remain exclusively on chain and get a certain baseline and then design around that with an extreme level of composability for others to then build on top, and obviously the Lego pieces get going. That's that gets me most excited. I think that economic design service is going to be massive, and then that's where I think about, the proliferation of LSTs and DeFi. I agree with you, Lepto. Like, it's already happened, and it's happened at a time where there, it's been by far the most tumultuous time in DeFi. While the TVL is going down, by 80%, we're seeing this, change of the guards happen. And I think moving forward, any new design, any existing DeFi protocol with a substantial amount of TVL is just going to continue to see um, liquid stake tokens just dominate, the deposits and the interest from their users. So I mean, that can't be ignored and won't be ignored. But let's go to Amplice, because I know obviously Gearbox plays across the board, and to that point, I feel like wrapped staked ETH has become a big component within the Gearbox ecosystem, enabling you guys to offer or give users the ability to get implement certain types of leveraged ETH staking strategies. But we'd love to get your perspective on this as well.
Yeah, so I think I'm bullish on LSDs or LSTs, like playing an increased role in DeFi, but at the same time, like just seeing the number of, honestly seeing the number of projects launch with like the LSTfi meme or whatever, like I think probably at least half of those are not going to make it. Just because seems like there's so many, and I don't think, I think like to some extent, various forms of staked ETH will replace WETH, but only to some extent, because I think a lot of people are treating staked ETH as kind of like a quote unquote risk-free rate, but like staking your ETH, whether you're doing it like solo staking or whether you're using a product, is not risk-free. And so like whenever we see, which is definitely going to happen, right? At some point, we're going to see like some staking protocol have like a hack and it's going to go to zero somehow. And then a lot of these products, like the ones that are built well, will survive because they'll have taken into account this risk. And the ones that have just been like, oh, like all staked ETH products are the same. We're just going to like have a basket or whatever. And then like suddenly your stable coin, which is supposed to be worth 1, is worth like 75 cents or whatever. Like once we see that, then we'll separate the wheat from the chaff, and we see like which of these products like are well designed and which are kind of have design flaws. That makes sense. So that's kind of what I'm thinking. Like, yes, it's going to be big, but I do think like the meme that like everything is going to be LSTfi is probably a bit overplayed, especially in terms of just the number of things I'm seeing coming out. And then on the Gearbox side, like our goal is basically to provide a leverage layer for, well, ideally everything in DeFi, but specifically with LST, like we're looking to integrate as many of these protocols as possible. Basically the idea being like, you can just leverage up your Lido or Rocket ETH or Coinbase ETH, or like wherever you want to fall on the decentralization spectrum, whichever staked ETH product you want to use, you can get leverage on it. So that's kind of our goal. But again, like picking and choosing which protocols you integrate with, I think is going to be like a key differentiator between the products that survive long-term and the products that kind of are impacted by, security things and things like that.
Yeah, I think that's a really, really important point that you made there, because often when DeFi protocols are being designed, it's rolling with the narratives. What's gonna get the most attention and hype, and that design surface, and most, if not all of those kind of products or protocols usually don't make it. But nonetheless, like that criteria for determining, that level of integration, I think that's a great question to kind of, or topic to discuss is, when you think about integrating LSTs into your protocols or products or designs or whatever it may be, like what is the criteria that you think about? because you can go the decentralization maxi side, which is often broken. If you really look at the full spectrum of those LSTs beyond the validator set, you then go to the actual liquid stake tokens and so forth. But nonetheless, you know, understanding whatever that criteria is, if it is, market cap of that given asset or whatever it is, that criteria is obviously critical. I know for EBTC in particular, as we were designing it, we opted to go single collateral only. And because of the lack of decentralization at a liquid stake token layer across any of the solutions, we opted in for staked ETH from Lido as the sole asset that backs EBTC for obviously market size, along with potential addressable market for the BTC that we're actually building. But what do you guys think about that criteria? And I think starting that question with the unsheath crews is probably a good one, because taking the basket approach means that there needs to be some pretty specific criteria in place as things get added to the basket. And I know there's governance around how things are added, and I think that gets a little shifty too, especially when governance incentives are not aligned accordingly and people act with their own monetary interests in mind. But I'd love to get your perspective on that.
Yeah. So there's a good analog here in the stablecoin world. I think it's helpful to refer to that when thinking about how important is decentralization when integrating an LSD. USDC, whether we like it or not, is the backbone of DeFi. It's the most popular stablecoin, and even DAI now has a USDC component to it. Um, Fully decentralized stablecoins like LUSC and their ilk, they are unfortunately just not as popular. So I think as a protocol, um, you have to sort of make a trade-off between you want to have decentralized collateral. You don't want to have too much exposure to a coin that could essentially rug you, right? But at the same time, you don't want to only support sort of niche, long tail, giga decentralized assets that very few people use. You have to strike a trade off between sort of usability of your protocol um, and sort of not taking on too much risk. Uh, for unshETH specifically, I mean, uh, we diversify the LSDs that we support, and we don't just look at, oh, like this LSD is decentralized, this LSD is decentralized. We'll take both of them. We actually think that centralized LSDs, and a lot of people may not agree with me on this, uh, they actually do play a role in uh, improving the decentralization of an index or a basket containing LSDs, right? Because you are, at the end of the day, diversifying your risks. If you have one LSD that's super decentralized but has a point of failure within, like, let's say it's DVT technology, you have another LSD that's sort of run by a centralized exchange in some jurisdiction, you have, weirdly enough, diversified your risk. Now, if you had all LSDs using the same DVT and they were all in different jurisdictions, but there was like a point of failure within the DVT tech they were using, then you'd actually be worse off than if you had like 50% of one centralized exchange LSD and 50% of what, um, of like one DVT, like decentralized LSD. So going back to what factors are important to consider for LSDs, it's not just um, how decentralized are they, meaning like what kind of DVT are they using. It's obviously about like the jurisdiction of the node operators, where are the node operators located, and on the validator level, what sort of client diversity do they have, right? There are a number of different clients you can use for running your validators, and I think best practices now are to actually have some diversity to the clients being used, so that if there's a bug in one client, it doesn't affect the all of the validators being run by a validator. I've said the word diversity too many times in this response. Um, but again, I just want to emphasize that at the end of the day, the goal is really to maximize of the amount of TVL your protocol can support and reduce the like rug risk, right? And that can be done by picking out decentralized LSDs, but I think, yeah, like you have to sort of include some centralized LSDs at least for now, um, in order to, well, have users. That's my 2 cents.
We talked about the validator side of things, but like, what's your opinion on the actual upgradability and centralization vectors in the actual liquid staked token that represents obviously what's happening on the other side for that staking protocol? 'Cause that plays an important role, right? Like that's
Yeah,
pretty
so
critical. You can have the most decentralized validator set, but then 5 or 6 people collude to say, "Hey, we're gonna go and mint, 100x a supply of this liquid stake token," and then all of a sudden, or those people are in a position where, to your point, jurisdictional risk, whatever regulatory risk that comes with that could impact that pretty significantly.
yeah, I think it's not black and white. Upgradability obviously is not ideal because well, like you said, there is a rug risk. This can be mitigated by, putting it behind a time lock such that if there's a malicious upgrade, people are able to get out before this malicious upgrade goes in place. In an ideal world, there would be no upgradable smart contracts, but um, unfortunately, with the nature of these DeFi protocols, it's almost impossible to just write something once and have it work perfectly and never need to upgrade. If you don't have upgradability, you're gonna one day have to force a migration. Um, in the event that something does happen. That being said, I know a lot of these protocols, especially the centralized ones, they have upgradability where it may not strictly be necessary. Um, I'm not sure if the purpose of that is to, insert KYC at some point in the future or what, but yeah, like I said, it's we again have this trade-off of like uh the idealism of, we don't want upgradability, we want it to be fully decentralized. Um, I think that you have to evaluate every upgradable protocol individually and look at basically all the ways that the protocol operators can, to put it bluntly, fuck over their users and sort of plan around that, right? Maybe that could be like for the unshETH index that involves um, setting caps on, the total amount of one LSD that could take, comprise the index. So if there is, a brand new LSD that offers super high yield, but it is upgradable, we can do something like limit its maximum weight in the index to 5%. That way, if something catastrophic does happen, the maximum loss to holders of unshETH would be 5%, right? So yeah, TLDR, evaluate upgradable protocols individually and sort of plan for them to rug and just try to minimize the impact of a rug. Um, if if it's a very popular asset that you need to support.
Fair enough. I'm gonna point that question at Anton. I know there's probably a lot of work that goes into evaluating different LSTs as Pendle looks to integrate them and then build structured products around that naturally, like anything, could significantly impact the value proposition of the protocol and product if there is certain issues across different LST markets. But how do you guys think about the criteria associated with integrating new LSTs and that whole opportunity?
Sure. So from Pendle's perspective, we definitely want to work with as many LSEs as possible, where we allow the users to trade their yield, right? But we definitely have to evaluate their overall design to see whether it makes sense. So off the bat, decentralization is definitely something very important as it lessens some security and trust assumptions when supporting the asset. I think this is inherently true for any protocol that we'd want to work with, even for non-LSDs. There are other important areas aside from decentralization that we look at as well. For example, the reputation of the team behind the LSD and their ability to execute, especially if it's something upgradable. So we want to make sure that they're able to they basically have some reputation to be able to execute that. Um, yeah, the safety and the soundness of the smart contracts as well, the overall mechanism design, such as the process of redemptions to native ETH, how yields are basically being accrued and distributed back to the holders, and how slashing handle, etc. So we usually do an audit for each listing to make sure we don't overlook something. Um, Decentralization, I would say, just adds to that assumption that such rules cannot easily be changed by a central party. And if those rules change or can be changed, what is the process like to have those rules change? They've also been in talks with different institutions and liquid funds, and they have different risk appetites, sizes, and mandate restrictions. And in the same way, they are taking the time to evaluate different areas of risk in the form of those issuers of the LSD, smart contract risks, etc. When dealing with the LSDs. So we just have or are looking in the same way on how we evaluate these different assets. But even having said that, as what's said by unshETH, despite all those criteria, you end up wanting to support the most popular and the most liquid one anyway. So yeah, it's all about, giving options to users, what trade-offs you're willing to accept, and just giving back the power to users to decide for themselves what risks they are personally able to assume for themselves.
Yeah, I think that the theme there is like no matter how you slice it, the space is so immature, and with immaturity comes forced trade-off because there is no, absolute perfect kind of option. So it's always going to be a trade-off of sorts. I can completely agree with that. But Anton, I want to just follow up to a point that you made because I think this is interesting, and I'd love to get this perspective. You talked about institutions and crypto institutional capital allocators. Like, how are they thinking about LSTs and how that could be used? Because I know, many years back, I say that many years because crypto ages you every year is like 100 years. But, even a few years ago, when DeFi summer was starting to rock and roll, a lot of the more traditional crypto funds that managed billions of dollars were still not able to confidently participate, primarily from a regulatory standpoint in DeFi. And obviously that opened the door to what many will believe most of the bad actors that are now bankrupt taking advantage of some of those gray areas. But how are they thinking about how is institutional capital thinking about LSTs and how that's used within DeFi?
Yeah. So one of the main motivations why we are talking to these different institutions is that that's basically where the liquidity and volume comes from, right? So we definitely want to onboard them into, DeFi and LSDFi. But according to them, there's a lot of restrictions in place before they can basically put in size right into these different assets. And I think the first and foremost restriction is regulatory in nature. And I think it works well for the most mature LSDs in the market. So, speaking uh, I think that would be like, stake ETH, SDETH, RETH, et cetera. And, with time, right, comes Lindy. So I think they would kind of like show that they are the most robust in the market. And I think, I think that those are kind of like the main areas that they describe and kind of like what kind of like prevents them fully committing into DeFi, right? Or fully committing into the LSDFi are those, mainly regulatory in nature. So other than that, I would say that, that's kind of like the main issue.
And would you say that there's hesitancy from taking naked ETH into staked ETH, or you've seen that proliferation kind of already happen with some of this institutional capital, and now it's more and institutional, that word needs to be prefaced, right? Institutional in crypto is not the same as institutional outside of crypto. Let's just kind of call it what it is. But nonetheless, where are you seeing that regulatory hurdle at the putting it in to a liquid stake token or using that liquid stake token in other ways?
Yeah, it's mostly putting it into liquid staking. So actually, there are solutions out there that are trying to, do something like lighter, but more targeted to institutions. So, for example, there is, I'm not sure if I'm able to reveal it, but anyway, they're able to provide a liquid staking solution for these institutions where, you know, only these institutions are able to mint using their solution. And then that liquid stake asset can then be used for the rest of DeFi, but only institutions can mint that. So I think that, they probably have solved that regulatory issue over there. And maybe that's some way or method to be able to get them into LSTfi in general. But yeah, it's really too early to say, right? We haven't really heard news on big institutions getting into, let's say, like stake ETH, right? In large sizes. But maybe like in the next few months or so, once the space or this particular sector matures more, they will start hearing more news about it.
Oh, beans. Well, I'll point the baton at Lepto. Like when you think about, you know, in the stablecoin space in particular, like how do you think about evaluating ways to bring more value to obviously a very competitive space in general, and even thinking about the opportunities that can come from LSTs or integrating LSTs into, the back end of some of your strategies?
Yeah, I think for us, it might be slightly different with some of the other speakers where we have quite a bit of platform dependence on other either centralized exchanges or decentralized exchanges in terms of what they'll allow us to use as collateral. So often that decision doesn't sort of sit solely with us. It's usually a function of what they're open to in terms of risk allowance on that side. I would say it does look slightly different, and it sort of converges to more of a focus around liquidity rather than decentralization, where that's obviously been the path that Lido and unshETH has followed, which is sort of focused very much on making sure that you have the most liquid LST, which sort of makes them more useful as collateral on decentralized and centralized exchanges. So from our perspective, like I would say, we obviously do think that decentralization is important in certain aspects, but for us, like liquidity is a larger driver versus decentralization.
Yeah, I'd say that's the theme that we've heard here. And I even, spoke of it for how we thought about, the eBTC design, and eBTC was interesting about that kind of design exercises. We were committed to removing any influence that humans can pose by making the contracts immutable, and removing a lot of the traditional governance parameters that are associated with either synthetic assets or stable coins or whatever. And again, where does that point you to? That points you to, well, how decentralized are the liquid stake tokens? Where's that barometer? If that barometer can't meet a certain standard, which in my opinion, none can, then the next most logical thing is liquidity. And I think, at this point in the cycle, liquidity rules all. But Amplice, anything that you'd want to share that folks haven't spoke to or around that specific point?
Just like quickly say that I think like which LSTs you integrate is going to depend on like what your product is, right? So like if with Gearbox, we just want to kind of onboard anything that we think is relatively safe, because our protocol, like especially with V3 and later this year, our protocol can like withstand like other protocols go to zero, because like people will just get liquidated. And as long as the liquidation bots are working well, our protocol risk is limited, right? And like basically, like if you're using leverage on some staked ETH token of some kind, and that project gets hacked and you lose all your money, like you were using leverage on that and you got liquidated, that's your fault. But Gearbox survives, right? And like other protocols that have that similar framework, like Curve, right? Like their pools can survive individual stables going to zero. Whereas there are things that are like as weak as their weakest integrated project. Like I think a lot of stablecoins are like this, where you're kind of only as strong as your weakest collateral, right? So like one of your collateral goes to zero, then your stablecoin is no longer at $1. It's at like 0.7, then it's not a stablecoin, and there's no point in having a stablecoin that doesn't stay at $1, right? So I think like decentralization versus like the other things that people have talked about is one thing, right? Like there's regulatory risk, and then there's like, I think the more decentralized the LST is, kind of the more probably contract risk there is with like, especially with DVTs and things like that. But there's also this element of like, are you one of these protocols that's only as strong only as strong as your weakest integration or your weakest collateral? And if so, then the way that you decide what to integrate is going to be different from something like Curve or something like Gearbox or some of the other projects in this space right now that are like, actually, we can withstand one of these going to zero. It's fine. We've built our project around the possibility of that. And if you can survive that, then you can kind of integrate freely with anything that you think is relatively safe. Does that make sense?
Yeah, it definitely makes sense. I think the conversation kind of continues to circle back to this somewhat immaturity or youngness of this space and the continued trade-offs that need to happen. And I think that um, one of the things that folks have talked about and you've continued to see people get excited about, which I think in some instances actually can increase the risk vectors just because there's additional layers on top. But I'd love to get the opinion from the group here is this idea of restaking and how restaking is going to play a role in the adoption of more ETH stake, in the proliferation of how that's used across. But I can see a world where, like we saw just a few years ago, like a wrapper of a wrapper of a wrapper with some fun token kind of games on top. And that's a big catalyst for growth with, asymmetry of information around, certain groups and certain capital allocators. And I think that naturally will accelerate some type of kind of craze. But it'd be good to get the group's perspective. Maybe maybe Amplice, if just because we kind of kept going to you last, but to start us off there, like, what do you think about restaking and how much of a role that's going to play?
I mean, for firstly, I'll say, to be totally honest, like, I don't fully understand how that works from a kind of like a technical level. I think the idea of boosting yield by using staked ETH to secure other things is cool, right? Then basically, like, you think about traditional bond markets or whatever, like, you take more risk. So like, okay, there's US government bonds, then there's like Japanese bonds or whatever. And then there's like corporate bonds, which are like more risky, more return. And I think Eigenlayer restaking, I don't know if there are other projects doing the same thing, but that's going to introduce that element of like more risk, more return, and you understand where the risks are coming from. And if the thing that you are trying to secure like goes haywire, then you're going to lose money. I think that's good. Like, I'd be excited to look into integrating it into Gearbox. But I think there are like concerns that Vitalik and others have brought up where, like, how many layers deep do you want to go, I guess? And like, to be honest, I don't understand the risks versus the rewards. Like, I think introducing this concept of like, oh, you can add more risk and get more reward is good, but you don't want to jeopardize kind of main chain security either. So like, if it's a case of like DeFi Summer where everybody's just jumping on the highest yield possible, then that presents a problem. So like, I guess it comes back to like, in the end, the problem is us. Like, if we behave relatively responsibly, then Eigenlayer will be fine. But like, if everybody's just like, oh, max risk on, jumping on the highest yield possible and like restaking into everything, and that compromises like mainnet security, that's probably not ideal. So I guess control yourselves, people, is what I'd say.
Yeah, that's hilarious because you're talking to a bunch of apes and degens. Like, right? Like, that's the funny part. Like, we have to control ourselves. We're just disgusting animals when it comes down to it, because we've seen what's happened time and time again, and I don't think this is going to be any different, right? I think
This is
there's going to be
unfortunately true.
asymmetry, right? It's just
Yeah.
what it is. Like,
Yep.
that's the main use case of crypto today is, using and trading and doing all this stuff around speculation, and speculation's driven by different narratives. Narratives are driven by, which capital allocators are getting behind certain types of narratives. Like, the space is so small and the capital is so concentrated that it's relatively easy for some of that stuff to happen. So I think inevitably, main chain security will see an existential risk, or has an existential risk, if that starts to proliferate, which I can't imagine how it couldn't, right? Like, look at Eigenlayer already. there's $60 million of TVL, if not more, and that's capped. That would probably be at 500 million. And the question is like, well, why? Well, for the most part, it's not like that staked ETH is being used in any way today through Eigenlayer, right? They're still developing the demand side of their marketplace model. But what are most people doing? Well, call it what it is. You got Eigenlayer that's, raised a substantial amount of money. Everyone's talking about them. Everyone's behind them. Now all of a sudden, they're introducing the ability to participate. People are assuming that there's going to be some type of token around it. Like that's just how the space is wired, which I think is, again, part of the immaturity. It's obviously concerning, but I too think that it's on us, and unfortunately, I'm not that confident in us. But maybe the unshETH. Could you guys any perspective around that, or any thoughts? Do you agree? Do you disagree?
Yeah, so I'm actually a little more optimistic about restaking. Reason being that uh the tokens of all these other chains and these other networks are typically valued at an order of magnitude more than the shit coins that you would ordinarily be farming, i.e., they present kind of like ETH staking, they present a more scalable source of yield, right? So in theory, you should be able to rehypothecate and secure other networks with staked ETH, and sort of the maximum amount of capital will be in order of magnitude higher than what your standard like Yearn Vault as yield farm could support. Um, so I'm bullish to the extent that we can get more sustainable, scalable sources of yield. But yeah, then obviously someone's gonna come along and create a vault that farms it, and then that vault is gonna be used as collateral somewhere, and then you'll have another vault on top of it, and we'll have our 2020 yield farming alphabet soup tokens again. That is inevitable. It's going to happen. Some of those leverage products might blow up, but I think the core value prop of restaking is extremely enticing. Um, but like the others have said, I'm sure there's going to be some irresponsible uses of leverage. But I do believe that any blowups that happen from that will likely be contained. It's there's not going to be nothing on the order of like um a systemic risk, mm, as long as the apes sort of remain in shape.
Yeah, nice analogy there. Well, like, let me ask you though, when you say, there is forms of, uh, scalable yield on some of these other networks, isn't that just like the same, certain capital allocators, again, with concentrated capital, or some of the most concentrated capital in the space got behind a lot of these projects. Those projects then were listed on exchanges with market maker support and blah, 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 blah. Like, is sustainability in the fact that, they can do token games and token launches and maintaining token infrastructure better than others because that's what the narrative is? Is that like, I don't see that being sustainable or scalable by any means.
Well, let me put it like this, right? In 2020, I could earn food Ponzi coins with my ETH, right? Those food coins were never really worth that much, right? But if you tell me next year I can earn Solana with my ETH, or I can earn Tron, or I can earn Matic, those tokens are just they're worth more. There are more people that can farm it by way of restaking. Now, I'm not saying Eigenlayer is going to support those. I have no insight into Eigenlayer's roadmap. I don't even know if it's possible. But uh, what I'm getting at is that when there's a yield farm, there's typically only so many people that can profitably farm that coin before that resource is sort of exhausted or depleted, right? And that's why we saw like the first wave of this DeFi winter where all the yields compressed. Um, this time around, the tokens that can be earned through restaking, right? They are going to be worth more, and you can say that, oh, they're only worth more because um large capital allocators are behind them, but that kind of that doesn't make it any less real. Do you see what I'm saying?
Yeah, yeah. I'm not saying. I think the point is it's like regardless of how real it is, sustainability. I just take a look at the coin market cap top 10 or coin. CoinGecko wasn't around, but coin market cap top 10 from 2016. Right? Like a lot of people would say, and I know the market was significantly smaller, but oh, this coin, has this type of market cap. It's a top 10. If there's farming capabilities for that, then that's more sustainable. Or it is sustainable. It might be more sustainable than some random new coin that comes out. But I kind of get your point across the board. But I
Yeah,
want
like
to put the go ahead.
just real quick, the alt chains, whether it be Tron or Ripple or EOS, they've actually held their place on the leaderboard better than a lot of these DeFi coins. There's been more variance in the DeFi side of things. Uh, to my point, right? These are more sustainable sources of yield. So I'll see you next year when I'm earning XRP on my staked ETH.
Nice. Might as well just go for ADA. Lepto, Anton, anything that you guys kind of want to add to that point or any thoughts around restaking that you want to share?
Yeah, I mean,
Yes.
sorry, go ahead.
Yeah, go ahead, Lato.
There you go.
Okay, sure. Thanks. Yeah. So, coming back to Eigenlayer, I just find it interesting as a new primitive in the market. So they basically commoditize crypto economic security for protocols on the application layer. And so basically restaking would make sense if you're, let's say, spinning up a new bridge. Instead of minting your own token to spin up a new validator set and bootstrap security, you can instead make use of the existing validator set or securing Ethereum through restaking. So I guess, much less of these governance / staking tokens in the market and, just making more use of ETH in general. But yeah, I mean, coming back to Vitalik's point where, he makes a good point on overloading consensus, because now not only are the Ethereum validators securing Ethereum, but also are they securing something else in the application layer. So maybe it's too early to say, and we don't know the repercussions that Eigenlayer can introduce, but, I would be happy to see that experiment play on and see what happens.
I was just going to add, and I sort of echo all the comments from everyone else, that I think if the incentive's there for us to take more risks, that's ultimately what's going to happen. I do think that there is also a scenario where it's potentially quite bearish for a couple of the products that I think we've been sort of discussing today, where if Eigenlayer introduces more incentives to stake outside of the normal sort of incentives that sit within Ethereum's monetary policy, there is sort of a scenario where the amount of staked ETH goes well beyond sort of a level that makes sense for everyone else who's not engaging with Eigenlayer. And what I mean by that is that staked ETH, if we sort of say whatever the sort of target percentage of staked ETH is relative to ETH, called it like 30%. If Eigenlayer starts to push that to 50 to 60% and sort of crowd out the yield for the rest of the ecosystem that can't sort of leverage Eigenlayer staked ETH collateral, that could be pretty sort of bearish in terms of the unit economics of some of the products that we're sort of trying to build here. So I think there is potentially a pretty bearish implication for other products that sort of leverage staked ETH as it exists today.
Yeah, I can see that. And that kind of goes to unshETH's point, right? Which is the sustainability of kind of the, I don't want to call it farming, but the sustainability of the deposit incentive. Like, obviously, if you have a bunch of new projects that, kind of spun up in the last 3 months or 6 months, as we've seen with a lot of kind of, to Amplice's point, this LSTfi kind of meme to an extent, which is like when people or projects kind of speak to that being exclusively what they're doing. But you look at, a group like that trying to compete with or drive some type of speculative interest in the incentive program that they're putting together, which is often tied to tokens versus Eigenlayer or, something similar that again has 50 or 100 million in backing from reputable folks that again are also the folks that have the type of represent the concentrated capital in DeFi today and the influence across everything else that kind of helps support, token prices. Most are just going to opt in for quote unquote farming the better token, right? So I do agree. I think that becomes challenging, especially for protocols that are designing around liquid stake tokens and trying to bring value to their user base around those liquid stake tokens. I think on the flip side of that, it also forces, builders that are designing these types of protocols to focus less on what the incentive game is around the protocol and more on the economic sustainability of the actual protocol. It's actually filling a need. It's actually doing something better than what other people or what other protocols or projects, centralized, decentralized, doesn't matter, are actually offering. And that's probably one of the biggest realizations that me as a builder, building through early DeFi summer and in 2020, through to now, is so much of kind of those incentive schemes, and schemes I use very loosely, but those incentive programs, they build kind of this smoke and mirrors layer around the actual fit of the protocol and what's actually being offered. And if you look at like the real use cases today, we talk about obviously liquid staking. You could talk about stable coins, you can talk about dexes, you can talk about money markets, but really outside of that and within each of those categories, just kind of one leader. Um, that's the extent of the types of DeFi protocols that have found some type of fit and also provide a service or value to users that they either can't get other places, if that's cost, composability, whatever it may be. So I think that, that's the bearish and bullish case. Is it most likely will converge around the tokens with, the most excitement and potential long-standing capabilities. But at the same time, I think it's going to also force innovation for builders to create designs for protocols that are less reliant on those incentives. And then, of course, we'll have a wave. And the ones that are everyone's talking about on CT are probably the ones with the biggest incentive programs, and they'll come and they'll go. And then the ones that kind of stick around and kind of keep building and focusing on finding that fit, a small percentage of those will make it through the tumultuous roads that are, building in DeFi and crypto in general. Okay, I'm just taking a look at the time. So we're on the hour mark. I'll throw a question to the group and then maybe we can open up for questions if there is any. What's the single most exciting thing around ETH staking? We've talked about a lot of them. But if you were to pick one thing, what would you say is the most exciting thing around ETH staking looking forward that gets you fired up? And whoever wants to kind of jump on that first, feel free.
Achieving validator decentralization, obviously.
Alrighty, so we got decentralization and that actually progressing to a point where we can say with confidence. Amplice, what are you most fired up about? And if you say leverage on leverage, we might have to kick you off the stage. Okay.
Well, I'm excited to see more staked ETH protocols integrated into Gearbox. I think Lido is great, but having more options for Gearbox users would be great. But more broadly, I think so. For example, I think what Pendle guys are doing and what other kind of fixed yield projects are doing is really cool. And I think what we've been missing up till now is some kind of quote unquote real yield to base it on. And so I think the development of a genuine, a lifetime ago, I was an interest rate exotics trader. And I think the development of a real rates / bond market or something equivalent on chain would be really cool. And I think Eigenlayer is probably a part of that. The different new protocols are a part of that. So the development of that market is going to be really interesting to watch, at least for me. So that's kind of what I'm excited about.
Yeah, just to add to that, like a Pendle and as Amplice said, right? So we're kind of trying to build that term structure with these different liquid staking tokens, stake ETH. So, with those different maturities, I think we can build that yield curve where users or funds or et cetera can, gain exposure to these different assets with their own risk profiles, right? So yeah, I think that's something that, I'm personally excited about at Pendle. But aside from that, I think that, with this explosion of liquid staking, we will see more and more new primitives that will take place, and, maybe gain footing right in the next few months. So maybe it could be something like, LSTfi summer or autumn, right? And we might even see a bigger explosion next year on that. So yeah, I think, maybe this would be the start of the new cycle, but who knows? Just as forward looking on that.
I would agree on the structured product side. I think if we think like what starts a bull market, usually it's like real new net inflows into either Bitcoin or ETH. And I think life cycle was sort of characterized by Sailor coming in and buying all the Bitcoin. I think the logical sort of step that I would imagine this cycle sort of kicks off with is actually institutional capital finding structured products around ETH being an interesting place to get sort of upside exposure to sort of like a tech asset class, but then a yield that's attached to that as well. So I guess just echoing the comments of Anton and Amplice, I think putting interesting sort of structures around that yield and sort of packaging it up in a simple solution for net new money to come into the space is probably the most interesting thing around LSTfi.
Actually, I take my answer back. What I'm most excited for is if this narrative can create a new bull, the like utter degeneracy and the idiotic things that we're going to see, and the number of times I'm going to be like, I can't believe people bought this fucking coin. That's what I'm excited about. So that's what I'm really pumped about.
See, that's honesty. Okay, we could all pretend sit on soapboxes, but that's honesty. That's pretty hilarious. Now, and just to wrap up, and if anybody that has any questions, raise your hand. We can bring you up. But in the meantime, just to give my perspective on that, I'd say I think a little bit less around, layer 4 and 5. Like when you start talking about structured products, I think you're going up the stack, up the Lego tower. I think more around, with more and more liquid stake tokens and that evolution of liquid stake tokens being used in existing protocols that are tried and tested, both from smart contract risk mitigation, market dominance, but more importantly, product fit, right? When you start thinking about stable coins and you start thinking about DEXs and money markets, I tend to think as more and more capital comes in the space, they're going to look to, that risk curve and say, obviously we want to start on the smaller side, right? On the lower risk of that curve. And I think naturally, once your foot is into a liquid kind of stake token and you're playing that's one, level of risk. Then you say, well, how am I going to use it? I think more of that larger capital allocators are going to look to use, something like a Uniswap or, a money market like Aave or things along those lines. But I think naturally that's where it starts. I'm excited about that because I think that's just net positive for the space, right? More and more capital on DeFi rails, pushing the no pun intended, buck forward. But I think as well, what I've said this before, but I'm gonna just echo it again, is like the economic design space for protocols and how those protocols are built and how that is going to be impacted in a way that wasn't possible before because of that baseline ETH staking yield. Again, I think it's just going to explode, what can be built and how that can continue to be more competitive towards, non-DeFi oriented things and how that starts onboarding more and more users, more and more capital into the space. I think, at least for me, that's what gets me the most excited. Alrighty, so doesn't look like we have any questions. It's been great talking, guys. Anything that you want to add or say that you didn't get a chance to say? If not, Will, why don't you take us home? From my side, again, I really enjoyed the conversation. I think we hit a bunch of really great topics. We're able to speak to things that a lot of the times people, are not as straight up about, which I think is a bit of BS. So I appreciate you guys, being honest and transparent. And the more of these conversations that we can have, the better, right? So it's been fun, and thanks for joining. and letting me lead the conversation.